With that, we'll shift gears and welcome in our next guest. That's Chris Ward, the founder and senior wealth advisor for Entry Point Wealth Management. Chris, good morning to you. Happy Tuesday. Let's talk some Fed. Somewhere hidden within all these market dynamics is, of course, the FOMC meeting this week. Not a lot expected when it comes to a decision on rates this time around. But a lot of focus on the words and the wording. What do you expect will happen?
Yeah, I think the Fed's really in a tight spot. You know, when you think about where we are as in an economy and the global pressures that are being created by the Iran conflict, the job market is starting to get stale. Obviously, we just heard a great report with Delta, but a lot of companies are kind of not blowing earnings out of the water this quarter. And obviously the real estate market is really stale, so we could definitely use some help. I think this is a period where the Fed needs to take aggressive action to stimulate the economy, reduce rates, but they're kind of held helpless. You know, they're not going to do anything. They're going to rely and sit on their hands. And I think it's a misstep with respect to what our economy needs, and kind of the breakdown that we're seeing in the general economic environment.
Before we get into that, just to clarify, you're suggesting policy, in your eyes, should be a little bit more dovish, a little bit more accommodative at this point,
Yep.
Not suggesting a reaction of rates higher.
Correct. Yeah, I feel like we are on the precipice of going back into an inflationary environment. This Iran war situation, while the Fed could label it as a transitory event and gas prices are going to go back 15, 20 points lower than where they're at today, if it hangs around, the customers are going to feel the effects, right? And we already know that households are struggling with other aspects of what they need to be able to do, specifically with mortgages and real estates, household formation, those sort of things. So, lower rates are only going to help stimulate our economy, maybe be more of a benefit to Main Street as opposed to Wall Street.
Good stuff. Let's talk Wall Street, though. Markets have been a little bit wobbly, to put it lightly, let's say, over the last several weeks, a little bit more sideways to lower, as opposed to sort of the straight-up vertical fashion of the last 75% of 2025. Talk to us about your kind of big, bird's eye view of the markets right now.
Exactly. I think you can go back further. 23, 24, is pretty much almost a straight line. Just massive growth out of our domestic markets, especially large cap tech and the S&P 500. But if you look at, technical components of how to evaluate the market, just Friday, we were sitting on the 200-day moving average. And so we've really moved to establish kind of a trend lower. As a trend-based investing firm, we've taken capital, we've taken profits, positioned it into cash, recognized that we have a lot of negative headlines and catalysts happening today, and our investors really don't want to absorb those losses to the downside or what could potentially continue to evolve. So we're going to take some risk off the table, and I'd advise your folks that are watching to evaluate their investment portfolio and realize that if we can't hold this 6640 level on the S&P 500, we may have much lower to go. And I think they need to be really comfortable with their portfolio positioning. If they own individual names, if they own indexes, if there's ever a time to sell, it may be now as opposed to a month from now.
Okay, so let's expand on that a little bit, Chris. You gave sort of that trigger point, perhaps a break of that 200-day moving average. If you're feeling uneasy already, perhaps lightening up even before that happens, if it even does. But Chris, for those who are listening, they're following what you're saying, they resonate with it. What's the trigger that, not necessarily that the coast is clear, but that it's time to either ramp up some of that exposure if you take it off, or at least get back to the levels that you were before raising some of that cash? Definitely,
yeah. I think, we're not trying to call a bottom by any stretch. I think you need to let, a week, 2 weeks of a reestablished uptrend, formulate. And we're not really there at this point. As a firm, we don't see too many positive headlines kind of driving the news flow. And Trump's never been one to back down, and he's extremely unpredictable. So we don't know where the next 2 weeks, the next 6 weeks are going to take us. And so it's just one of those periods in time where if you are looking at distributions, or if you're looking at managing risk in your portfolio, like now is a time to realize that over the last 3 years, we've had extreme growth from large cap equity positions, and taking profits at some point is usually a good idea. We see this period as one of those time frames.
Chris, really appreciate your thoughts and look forward to talking to you again soon. Actionable, pretty straightforward thoughts on the market, so appreciate that. Chris Ward, founder and senior wealth advisor for Entry Point Wealth Management.